Hey guys, JC Parets here of allstarcharts.com, and welcome back to the show. We're doing this every month, and we're basically going to go through charts that I think tell the story the best as to what's happening in the current market environment, what's affecting stocks and interest rates, and the sector rotation that we're seeing underneath the surface. So if you like this video, make sure to say what's up at allstarcharts on Twitter, StockTwits, Instagram, YouTube. We're always around, so feel free to email us, info@allstarcharts.com. All right, let's rock and roll. Let's get right into it. I think the first one that we need to start out with is just the sheer outperformance out of commodities. You know, how I grew up, I've been in this business for almost 20 years. And how I learned it was that there are three asset classes: bonds, stocks, and commodities. I remember, when I first got into the market, remembering it was BSC, which was the ticker symbol for Bear Stearns. So obviously Bear Stearns doesn't exist anymore, but that doesn't mean that you have to forget about that third asset class: stocks, bonds, and commodities. And that really has been the leader. I mean, think about it. The S&P 500 is only a couple of percent, a few percent away from all-time highs. And what are we actually seeing underneath the surface is the S&P 500 making new 52-week lows relative to the commodities CRB Index. Here's a closer look, and you could really see it breaking down. This is S&P breaking down relative to commodities, because what's going on? The CRB Commodities Index is making new 6-year highs, and those of you who are familiar with the components understand that crude oil represents a big percentage of the CRB index. About a third is energy, and here's crude oil making new 6-year highs. So when you think higher energy prices, what does that mean? You think inflation, right? It's just the first thing that comes to mind. So you want to check in on the bond market, see what's going on there. We don't really care what the journalists have to say. We certainly don't care what the Federal Reserve has to say. We're interested in what the bond market has to say. So for those of you who are new to the market, you have a lot of people you can listen to. I mean, you have more people that you can listen to than ever before. You can listen to what journalists think, if that's something that you're into. You can listen to economists. You can listen to Wall Street sell side. Everybody has an opinion, and they all get paid to get your attention. But the real truth, in my experience, is studying what the bond market thinks. Forget about all those people. We want to study what the bond traders are thinking. Boom. So, what is the bond market thinking about inflation? Well, here we are looking at a chart of inflation-protected Treasury securities relative to traditional non-inflation protected. And what are we seeing here? We keep seeing these levels running up against all of this resistance going back half a decade or more. Man, it looks like a resolution's coming soon. And if oil is any indication as to what the bond market's going to be pricing in, we're expecting that volatile move to be to the upside, because we're already seeing the U.S. 10-year yield breaking out to new highs. We're seeing the underrated 5-year yield also breaking out to new highs. So the bet that we want to make, if the U.S. 10-year yield is above 1.4% and the 5-year yield is above those Q1, Q2 highs, what's the bet that we want to make? Higher interest rates. So we're looking at an ETF, EQRR, which represents the stocks that tend to do well when interest rates are heading higher. And as it turns out, when you look at the components of the EQRR, basically half of the stocks are either in the energy or financials index. So when you take energy and financials and you equally weight the basket, those two baskets, what do you see? You see both of these look exactly the same. So if interest rates are going up, what are the sectors that we want to be investing in? We want to be in energy stocks. Interest rates going higher, oil's going higher. You're going to get the best bang for your buck out of the energy stocks. And if interest rates are going higher, banks are making more money, and financials are doing well. Those are the areas that we want to be in. Cyclicals in general. So notice how the percentage of cyclical stocks, these value areas above their 50-day moving average, is going up. Right? So that means 50-day moving average is kind of like a lazy way to say, up short-term uptrend, right? Because if it's above a 50-day moving average, it's probably not in a short-term downtrend, right? It's kind of like a lazy way to do that. But that's not the point. The point here is what we're seeing is rotation into these value areas, financials, energy, and then even materials and industrials. If they can dig in here, now we got the whole family. So of course, if oil's doing well, maybe not of course, maybe this is logical to some of you that have been doing this for a long time, maybe this is new to you, but if oil's going up, energy's probably going to be outperforming. And if oil's going up and energy's underperforming, kind of like what we saw here, that's a big problem, right? And then they all completely fell apart. So the fact that oil's doing well, energy's starting to outperform, if oil's really going to go, we're going to see oil at 100, these energy stocks, and remember, these energy stocks have much smaller market caps than these massive growth tech stocks. So you can move a mountain with these Apples and Microsofts, or you could flick a pebble with it, which is what some of these energy stocks have turned into. Companies that used to be worth 80, 100 billion are now worth 2 or 3 billion. Much easier to move. You're going to get big time moves. And by the way, if you're interested in these slides, go ahead and email info@allstarcharts.com and make sure to use the password Sentiment Unwind. Make sure to use the password. I give a lot of presentations around the world, all sorts of topics. So if you're interested in this deck in particular, make sure to email info@allstarcharts.com. And again, use the password Sentiment Unwind, because what we're seeing here, prices have been falling for stocks since February. That's when the market peaked. You said it 1,000 times. Some people get pissed off when I say that. I don't really care. The bottom line is that is the best that the market was in February. If you recall, that's when IPOs were ripping. Everybody's got a SPAC. All the cryptos are ripping. Everything was working in February, and that's when everything stopped working as well. Since then, some stocks are doing well. Most stocks are not. In fact, half the NASDAQ is down 20% off its highs. 50% of the NASDAQ, half the NASDAQ's down 20% off its highs. 20% of the NASDAQ, or 22% of the NASDAQ, is down 50% off its highs. So massive corrections taking place underneath the surface, and that's not really anything new. If you're just looking at the Dow Jones Industrial Average, you really haven't seen that. As the Dow Industrials are kind of hanging out near this Fibonacci extension level, you've really seen it in the transports and some of the other areas that we're going to look at now. As you can see, the transports, the industrials were making new highs into the summer, and transports were rolling over this entire time. So we had been seeing, for you Dow theory enthusiasts, we had been seeing this divergence for some time. And then when you go down the cap scale, they all stopped going up in February. Mid caps, small caps, micro caps, you had like a little slightly higher high in March that quickly failed. It's been a hot mess since February. That is the best that the market was. But what I will say is, as messy as the market has been since February, we're not getting an expansion in new highs, that's for sure. We're not getting an expansion in new lows either. Right? Actually, we're getting fewer new lows. That's not really a bad thing. So that leads me to believe that this massive consolidation taking place in small caps is likely to resolve higher. That's what that looks like to me, especially with the resiliency out of the high beta names. Now remember, off the lows, it was a beta chase the whole way. The high beta names outperforming low volatility. And when you look at the value line index, this is going to tell you what the median stock price change looks like. So this is going to be your average Joe stock. Notice how it doesn't look like the NASDAQ. It doesn't look like the Dow Industrial Average because there's a lot more stocks in this. It's it's the median stock, right? And it hasn't done anything for most of the year. So if this thing's going to get going, this is going to be the tell, and you're going to see high beta outperforming low vol, and then the median stocks are going to go higher, which chances are it makes it easier for you to make money being long stocks. And so you're seeing Aussie yen hanging in there strong. You're seeing high beta hanging in there strong relative. So the inner market, to me, points to higher stock prices. And what does that mean to me, the inner market? Sure, we're looking for stocks to buy. We're going to get into a few that I like right now. But it's about understanding, does the bond market agree with that thesis? Does the commodity market agree with that thesis? Does the Forex market agree with that thesis? When we think about us being right, let's say we're right in this trade. Let's say interest rates are going to 2% on the US 10-year yield. Oil's going to 100. Great. What does the world look like in that environment? Financials are probably doing well. That XLF is probably breaking out, right? JP Morgan, Goldman Sachs, Berkshire Hathaway represents 15%. Those stocks are probably doing well. If oil's going up, those energy stocks are probably doing well. That strikes me as an environment where Australian dollars outperforming the Japanese yen. It strikes me as an environment that junk bonds are outperforming US Treasury bonds. It strikes me as an environment that inflation-adjusted treasuries are outperforming traditional treasuries. Those are the inner market implications, in my opinion, of the market doing what we think it's about to do, what we're positioning for. Now, what's even more valuable is thinking about what the market is going to look like if we're wrong, right? Because that happens all the time. So by looking at the intermarket relationships, we can get a heads up that we're wrong faster than just looking at the individual stocks. Aussie yen's probably rolling over in an environment where that thesis is wrong. The US 10-year yield's probably back below 1.4%. Financials are probably falling apart. European financials probably leading the way down in that particular environment. Copper is probably breaking down to new lows. Names like Freeport-McMoRan or COPX, COPX, the ETF, those are probably breaking down to new lows in an environment where that thesis is wrong. Crude oil is probably back below 76. All of those things are most likely taking place if this whole thesis is incorrect. And the beauty of all of this is that we don't have to put added pressure on top of our shoulders being like, oh my God, we have to be right. And, you know, our ego's going to get in the way even though price has proven us wrong. Like, no. We're only here to make money. So the best part about the fact that we're only here to make money is identifying what the market has to do to prove us wrong the quickest. Because I don't care that I'm wrong. I just want to know that I'm wrong as fast as possible so we can move on to something else, right? That's how that works. All right, so that was my rant on the intermarket relationships. But I definitely wanted to talk about that because I think it's important. We've got a trade. We've got an options trade. What I'm seeing here is, you know, new lows in the S&P, and we're just not getting an expansion in new lows. So internals seem to be improving. And if we're right on that bullish thesis for equities, you know, selling the S&P 500 puts here is probably a good trade. Volatility has spiked. You've got the VIX back into the mid-20s. So we want to take advantage of the fact that people are making donations. And as a market participant, you can choose to accept those donations if you'd like, or you can choose not to accept those donations and let other people accept them. You have that right. I prefer to be one of the people accepting other traders' donations, and by selling the S&P 500 puts, I like the 404s. Sean really likes that level. You know, that's the 25 delta, which is really that sweet spot. So we're selling naked SPY November 404 puts, 575 or better if you can get it. And the caveat is, if at any point the S&P 500 ETF SPY is closing below 404, all bets are off. Just to be clear, all bets are off if we're below 404. But we've got a long way to be wrong. We've got a lot of room here. So I like it. Traders are making donations. I say we take it for ourselves. All right. Question coming up, JC. China's just so bad. Is it so bad that it's good? You know, is China so bad? Everybody knows China's a disaster. It's not a secret. I mean, how much is already priced in? Right? That seems to be a question that I'm getting a lot from the newest market participants to veterans, right? That seems to be sort of a general question. And my answer is, it's kind of a, you know, two ways to look at it. Do you want to just, you know, shut up and just buy the relative strength while you bottom fishing this garbage? That's one way to approach it. Or is the bounce going to give you so much alpha that to miss that bounce, that could prove costly? I think number one, it depends who you are. You know, what are your objectives? Do you have a benchmark that you're tied to? Where missing something like that's going to hurt really, really badly. Again, getting back to who are you as a market participant? I like the fact that the technology stocks in China are still above their January 2018 highs when the internet stocks are getting killed. And that's really because you're just not getting the Alibaba and JD exposure in the technology that you are on the internet stock. So if you ask me, if you have to be in one, which you're going to be, I'd rather be the one showing relative strength in technology. But there is no trade if we're below the 2018 highs. If we're below the 2018 highs, you can't own it, right? It's that simple. Same, you know, we said the same thing several months back with the Chinese internet. If we're below that, you can't own it. You know, another interesting thing in emerging markets, that Latin America isn't working either. You know, so here we're looking at the S&P 500 relative to Latin America, and the S&P is making new highs. So Latin America continues to underperform. It's not just China, it's Latin America too. So when you look around the world, we're anchoring on the x-axis to the change from February 8th, which is when market internals peaked, and then the change from May 10th, which was that secondary peak in market internals where the cyclicals peaked and a lot more stocks ended up putting their highs in on May the 10th. So when you anchor to those areas, you can really see the weakness in Latin America and China. Look at Peru, Kuwait, Chile, Pakistan, Brazil, just some of the worst areas in the world. And when you look in the upper right, what are some of the best areas in the world? Russia, Saudi Arabia, that those shouldn't be a surprise with that energy exposure. But you can also see India. So when it comes to emerging markets, you got India, Russia, strength, and then the weakness has really been in China and in Latin America. You can really see it in that bubble chart. When you zoom out, the world looks great. I mean, let's not forget that any sort of correction that we're seeing is within the context of a 20-year breakout in Europe. 20-year breakout in Europe. It's just that short term, Germany's still stuck below all this overhead supply. So the question is, when is Germany going to break out of this base? U.S. financials, the XLF, looks pretty much exactly like this, and it broke out already. So to me, it's only a matter of time before Germany breaks out. If and when that happens, look for Europe to really be absolutely ripping. And what I find interesting is that Indian banks have been a great leading indicator. Notice back in 2018, U.S. and European banks were making lower lows, lower highs, while Indian banks were showing relative strength. Well, 2019 ended up being a great year for stocks, and Bank Nifty was giving us the heads up. And fast forward to last year, when the financials were making new all-time highs into February of 2020, new highs in European banks, but it was the Bank Nifty saying no, 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 and who was right again? Indian banks. So now that Indian banks are making new highs, what does that say about U.S. banks and European banks? If Indian banks are any indication, that means that U.S. banks should probably be breaking out soon, and we are right there, folks. We are right there. We keep bumping up against resistance, and the more times that a level is tested, the higher the likelihood that it breaks. Berkshire Hathaway represents 15% of this entire index. If it's above 285, I think you can own it. JP Morgan, if we're above 151, I think you can own it. Goldman Sachs, if we're above 376, 376, I think we can own it. Regional banks, if we're above those 2018 highs, the bet has to be that regional banks are going up and interest rates are going up with it. Right? So if interest rates are going up, the bet is regional banks higher, particularly relative to real estate, because when the market believes the rates are going higher, you're going to see regional banks outperforming. And when the market thinks that rates are going lower, you're going to see REITs outperforming, because fixed income investors that aren't able to get their yield in the bond market are going to go to the stock market to get that income. So you're going to see a relative bid in REITs, and you're going to see a relative bid in banks when rates are going higher, which is precisely what we've been seeing. So take a look at this one, ISBC, $4 billion regional bank. If we're above those former highs, I think you got to own it, but only above those former highs. Take a look at Lazard. If we're above the 2020 highs, I think you own it. Mid cap in Bermuda, $45 is the level there. If we're above 45, I think you own Lazard. And then let me just finish up with a regional bank in South Dakota, Sioux Falls, best ticker symbol in the business, CASH. Cash rules everything around me. Meta Financial Group, if we are above 54, we want to be long. If we're below 54, leave it alone. Above 54, I like the Meta long. This one comes from our Under the Hood report, which is a scan that we like to run that looks for stocks that are showing an unusual increase in investor interest. That might be insider buying, huge volume coming in, unusual options activity, social media mentions. For one reason or another, there are more lunatics looking at these stocks today than there were a couple of weeks ago. That's really all the list is. I'll show you the list. It's really all the list is. So once we create the list, just creating the list, that's the easy part. Then diving in and hand selecting the best opportunities with the best risk reward. I think that's where the real magic is. Meta Financial coming out there right out of South Dakota, Sioux Falls. So we talk about financials, we talk about energy. All of these cyclicals, energy peaked in June, but industrials, materials, and financials all stopped going up in May, right? So let's look at industrials. Are they going to dig in? Are they going to dig in and find support at those levels? They better, because if this is a massive top in industrials, these are going a lot lower, and the stock market's probably not doing all too well in that environment. If history has taught us anything. If industrials are getting crushed, I'd say that's probably a big, big problem for the overall market. So they got to hang in there. They absolutely have to hang in there. And then with industrials, it's really been the shippers. And, you don't see it in the large cap transportation index or the large cap industrials because there just aren't any shippers that are big enough to be large caps. But if you look at mid cap transportation stocks, small cap transportation stocks, you're seeing it across the board. Here's a small cap stock, Safe Bulkers. If we're above 4, I think we can own it. Below 4, you leave it alone. But above 4, that puts us above those former highs. And I think it's fine. Look at the Baltic Dry Index. Highest levels since 2008. Just an absolute beast. It's not the delivery companies, FedEx, UPS, Expeditors. These things have been getting absolutely slaughtered. One industrial I think is interesting. It's a waste management company that recycles lithium batteries. Pretty interesting stuff. This one actually comes from our Follow the Flow report, which looks for stocks that are showing an unusual spike in options activity, just like very aggressive directional bets in the options market. And again, longs and shorts, we first build the list, then we dive in and hand select the best opportunities. Cyclical Holdings, LICY. It's a waste management company, recycles lithium batteries, looking to break out on a relative basis. The risk reward is nice too. If we're above 1265, I think we can own it. Below 1265, leave it alone. Above 1265, I like it. And I think we get back to those former highs from earlier this year. The recovery, the world is back. Trade continues to work. Hilton's about halfway to our target. This one continues to work out well. Check out Hilton Grand Vacations. This is a $6 billion stock. It's different than HLT. This is HGV. If we're above those 2018 highs, I think you got to own it. I think you absolutely have to own it. Same thing with Boyd Gaming. If we're above those former highs from 15 years ago, I think you got to own it. And then here's Bloomin Brands. They own Outback Steakhouse. I see resistance, and this is a possible breakout. So the question is, does it hold? Does that former resistance turn into support, or does this one go down under? Sorry, I had to. Couldn't help myself there. But yeah, if we're above those former highs, you absolutely have to own it. Nice way to play that the world is coming back. Just waiting for this retail to break out. This is the equally weighted retailers index that has done nothing since January, and just looking for that breakout above 98. We're still not getting it. We're nowhere near that. We're still 10% away. So I think you could stay patient. I think you want to look at the areas in consumer discretionary that are already working. Look at Hostess Brands. This is Twinkie, TWNK, making new highs as we speak. So do you want to bet that all of a sudden Americans are gonna take care of themselves and not be fat and start exercising, or do you want to bet that they're gonna keep eating Twinkies? Right? I'm gonna bet that they're gonna keep eating Twinkies. If they want to kill themselves, that's fine. They're gonna do it whether I'm profiting from it or not. So you might as well profit from it. That's how I look at it. So if we're above 17, we want to own the Twinkies. Mid-cap consumer staple, obviously consumer staple. And then check out Lowe's. Lows above 211, I think makes sense. Below that, leave it alone. Home Depot's halfway to our target. These things have already been working. Look at Netflix on the communication side. If we're out of that box, if we're above 590, I think you can own it. And just in general, waiting for this IPO index to break out. When the IPOs peaked in February, stocks in general stopped doing so well, and we've really just gone sideways. So if you're looking for evidence of risk appetite out there, I think that's definitely one area for sure. In the IPO index. So before we get into gold, before we get into just bad news for anybody who owns gold, let's continue with the optimism here and take a look at NTR. It's a Canadian material stock. This one continues to show relative strength compared to its peers, compared to the overall market. This thing's $36 billion Canadian material, agricultural inputs, whatever that means. If we're above 59, we want to be long with a target up near 80. All right. So the gold bugs will tell you it's like this. Of course it's like this, JC. The Fed is printing, Powell this, inflation that. They'll tell you it's like this. But what if it's like this? And it's a massive, massive double top, right? It could be that. I don't know, right? You don't know. I don't know. Nobody knows. All I know is that these lines are going from the upper left to the lower right. And you don't need a PhD or be like a fancy technician to know that these lines are going down. And if you've owned these lines going down, it's because you're putting your ego above making money, because seeing these lines going down is not reason to own things. It's reason to not own things Gold just has not broken out, just has not resolved higher. So I don't know what the rush is. All I'm seeing is all commodities in the world going up except for gold. Here's gold making new multi-year lows relative to the commodities index. Gold miners making new 52-week lows. And if you want to get fancy and look at gold in other currencies, it sucks just as much. Gold price in euro, British pounds, yen, there's just nothing to like. These are continuation patterns in silver that are resolving lower versus in the direction of the underlying trend. That's no bueno. New 20-year lows for silver relative to the NASDAQ. Can you imagine owning silver or gold over the last decade instead of NASDAQ stocks? Like, the only reason you'd want to do that is if you were blindfolded when you were looking at your charts, right? It's like if you're an airline pilot flying blindfolded, why would you do that? That doesn't make any sense at all. This is still a downtrend, obviously. Silver gold ratio just not working. If precious metals are going to do well, you're likely to see silver outperforming gold. You just obviously have not. The equally weighted precious metals index is breaking down, so silver versus gold. And now looking at the base metals, looking at copper, I think this is the big one because gold underperforming, that makes perfect sense with interest rates going up. Great. But copper outperforming is also one of the key ingredients here. So sure, copper is consolidating at a logical place, right? Where it consolidated before. The question is this a massive top or a continuation pattern that resolves higher? If it's a massive top, then chances are interest rates are not spiking, right? Chances are financials are not doing too great. Chances are oil's back below 76 also. So we're looking for an upside resolution here to really prove that thesis to be right, because I don't know if that thesis is going to be right or not. I really don't know. But my suspicion is if oil's going up, right, and breaking out to new highs, copper's probably not breaking down. The copper miners are probably not breaking down, right? Could it happen? Absolutely. But is that the bet that we want to make? No. The bet we want to make is that commodities are doing well. They're outperforming stocks, and there's just really no evidence that that's changed. Saudi Arabia making new 15-year highs. There's a ton going on. So real quick, we have a few more minutes. I want to go over something really, really important, and that is the fact that natural gas has been ripping. So one of the things that's interesting is that natural gas stocks should be doing well soon as well. And I've got something interesting for you, and it's the fact that they are, where are we? Here we go. The Unconventional Oil and Gas Index, FRAK, is being delisted next week. They're literally taking it out, just as we need it most, right? Look at unconventional oil and gas relative to traditional oil and gas making new 6-year highs. Look at the names in FRAK, Conoco, EOG, actually I have them all here. Conoco, EOG, Pioneer, Hess, Oxy, Devon, Diamondback, Marathon. These things are beasts. And let me remind you that the coal index got delisted last December, right before coal futures absolutely exploded. So if that's any indication as to what we should expect here, is that these names should be doing very, very well. The ETF companies, oh man, they love doing that, taking out the ETF just before you need it most. And just want to finish up, listen, if Bitcoin versus S&P 500 ratio is above the highs from the former peak and you don't have long exposure to crypto, I think you're being incredibly irresponsible. I think there's that much alpha you're missing out on. If you're not long, you're short if the ratio is above 7. This is the most important index in crypto, folks. Equally weighted Bitcoin, Ethereum, Ripple, Binance, and Cardano. If we're above these former highs in the equally weighted index of these 5, we are off to the races, folks. Look at these bases. Cosmo, Algorand, Avalanche, Elrond. These bases are massive. If you are interested in these slides, email info@allstarcharts.com and use the password sentimentunwind. Once again, folks, I am JC Parets of allstarcharts.com. Email info@allstarcharts.com if you're interested in the slides, and make sure to use the password sentimentunwind. Thanks, guys.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.